Hey guys, welcome back to another episode, Trading with xhaka. In this video, we will explain the concept of supply and demand areas and explore how they differ from traditional support and resistance levels. This video will show you the best technique to identify high-quality supply and demand zones using smart money concepts. Lastly, we're going to cover a confirmation entry setup in the lower time frames to trade supply and demand more confidently. Like a professional trader, I promise you, dear friend. Knowing this technique will give you a huge significant advantage, as you will be trading in alignment with big boys, with institutions and the correct side of the market. Here is what we learn in this video. So dear trader, if you like advanced trading teaching that are back-tested with proof, make sure to smash the like button for me to show your support and subscribe to our channel. Thank you. Let's start with the basics. Firstly, what is support and resistance? Support and resistance are zones where the price has reacted in the past and could react once more in the future. Now on the chart, you've noticed that the price has pushed up, hit this area, and reversed. We call this area a resistance, indicating that for whatever reason, the sellers have opened short positions and the buyers have closed their longs. This double action is what makes the price reverse from this area. Following the price push down, hit this area and reversed, making it a support zone. Indicated that for whatever reason, the sellers have closed their short positions and the buyers have opened their longs position. This two activity going on that area is what makes the price reverse from this area. Big question, why do we need to mark these zones on the chart? Here are 3 important reasons. Number 1, the levels that price reacted to them previously have a high chance of getting rejected again. When we approach these levels, we will closely observe the price action in action for possible rejection. This will help us set our profit targets, especially if they are higher time frame key levels, because a small reaction to these levels would be a major reversal in the lower time frames. Number 2, identifying the market direction. When the price breaks through a resistance level, technically it shows that the buyers have overcome the sellers, signaling bullish momentum and possible upside continuation. Similarly, breaking below a support level shows bearish momentum. We want to trade with the dominant trend. And identifying the direction of the market is the first thing we do when we open the candlestick chart. Number 3, identifying liquidity. We know for a fact that when the price reaches the support and resistance levels, the price action traders look for trading opportunities. Break and retest. Traders will buy this pair if they see a sign of rejection in the zone. Will also put their stops below this level, predicting upward continuation. Now, if there is not enough liquidity to push the market upwards, there is a high chance for the price to break below this level, grab the liquidity, and continue pushing up. This happens every day. So the traditional support and resistance are considered liquidity areas as well. Now we mark 3 types of supply and demand zones on the chart. Depending on the market structure formation, this includes order blocks, order flows, and consolidation areas. Order blocks are optimized supply and demand areas. We have an aggressive buying with clear fair value gaps, leading to a break of structure. This is the latest candle that created the fair value gaps, so we draw it in. Notice how the price swept the liquidity below this candle before taking off. Comes a question. Where is the safest place to set our stop loss if we place a buy limit at this order block is below this wick where the movement has started? So we will add this area to our order block zone as well. Then we wait for a correction and get into positions when the trading opportunities arise. Once again here, this is the last candle that created the inefficiency. The same question. Where should we place our stop to be safe from market fluctuations? The answer is above this swing high. So we will also add this area to our order block zones. This might make the trading zone and our stock larger. Sometimes order block forms as candles with opposite colors in the middle of the heavy movement. We know that the institutions and big players love to use these zones to fill their remaining orders. So we also consider them as order blocks and look for trading opportunities when the price returns to these levels. Now let me explain to you the second supply and demand zone that we mark on the chart, which is the order flow. Order flow is buying or selling pressure was last buy, or selling pressure before an aggressive movement in the market. A bullish order flow is where the last bearish pressure was present before the bullish move. Similarly, the bearish order flow is where the last bullish pressure was present before the bearish move. Order flow areas are also considered a key supply and demand in smart money concepts. Example: we have this move that created fair value gaps in a break of structure. These two candles are the last bearish momentum before the drastic move happens, so we draw them in. Order flow area might be a large zone and usually contains the order block within itself. Sometimes the price reverses before reaching our order block and makes us miss the trade because it's rejected from the order flow area. However, this scenario also emphasizes the importance of closely monitoring market structure for optimal trade execution. Key supply and demand is consolidation areas. Consolidation areas occur when buyers and sellers are not strong enough to drive the market into a trending position, creating a sense that the price is trapped within a box. Situation persists as liquidity accumulates, eventually leading the price to a breakout in one direction. And the consolidation area becomes a key supply or demand for traders. However, we still need to have some imbalance before considering this area a valid supply and demand. For example, here, the price was consolidating in the Asian session before the London session opens. So this consolidation area becomes a perfect demand zone for long opportunities. Our stop will be protected above this zone, and we can set multiple targets. Now let me show you some of the best techniques to trade the supply and demand levels and enter at a better price. First of all, we always look for trades with at least 1 to 2 risk-to-reward ratios before reaching our first target. Our first target is the latest high that the price recently created. So if your setup has a 1 to 2 risk-to-reward ratio, you can set your entry at the start of the order, block and place your stop below the swing low to give the price room to breathe. Order block is a tiny area. You can add more rooms for a stop to be safe in case of market fluctuations. But if your order block contains a large zone, you can have your stop a bit below the ending. However, we use 2 entry techniques, and this is how we do it. If your trading zone is a large order flow or consolidation area in the first one, instead of placing the trade at the start, we will enter at the middle of the zone and put our stop below it. This way, we can cut our stop by a significant number of pips. The psychology behind this technique is optimizing our supply and demand area and our entry and exit points. The next technique, this is my best entry model. I always wait for confirmations in the lower time frames, which we like to do most of the time. Because no matter how good your trading zone is, there is always a chance for the price to ignore and break through it. We have already explained multiple entry techniques you can use in the lower time frames, such as change of character, entry or retracement levels. Still, here comes a very important point. When our trading zone is large, we need more confirmations to enter the trades because the market loves to take out the early buyers and sellers. Sometimes when the price enters a large demand or supply zone, it provides many false signals before reversal occurs. That's why we need a double confirmation after the change of character appears on the chart. When we are talking about the change of character, what do we mean? Let's just say, for example, we're in a downtrend and the market continuously makes lower lows and lower highs. Eventually, for some reason, the price makes a change of character. It violates the previous market structure high, signaling a possible reversal. Now this is when we look for rejections from the recent demand area created by change of character move. However, in case of a false signal, the market will continue to push lower, making us lose the trade. So, we will be looking for a double confirmation. We will wait for the price to break the new high to the upside and create a new structure level. This way not only got a change of character, but also the continuation of the market structure. So basically, a change of character should be followed by a break of structure for double confirmation. Then the new supply and demand level should be respected. Hope this is clear. Now let me explain it with a chart example. Here we have an obvious moving downtrend on the 4 hours chart. If we mark this order flow area, we would have a large zone to trade, so we will zoom into 15 minutes chart to look for confirmations to enter short positions. Here on the 15 minutes chart, the price makes a false change of character signal, but then continues pushing up. So a double confirmation would have been to wait for the price to break below the new structure level to confirm the reversal. Let me open the live chat to show you step-by-step example. Just to build your confidence on this strategy, remember to backtest to figure out how everything you learn in this video works. Here we have the euro-dollar in 1 hour chart. We have recently broken above this key level, which signals possible upward continuation. We have fair value gaps, which show bullish momentum, and this order block can provide us with a perfect long opportunity. Now let's zoom out to the 4 hour chart to see the market in the bigger picture. The 4 hours chart reveals that this area is an important higher time frame level, since it has rejected the price multiple times in the past. But look closely, the price action shows a sign of weakness and a possible break to the upside, because rejections are getting weaker every time, and it is possible for an even weaker rejection. Anyway, anticipation in the 1 hour chart is that the price is going to hit the close of these candles, at least even if a reversal is coming. So we will open a buying position precisely on this order. Put our stop below the zone and target the close of the latest high. The price triggers our order in the London session, which has a high liquidity, and it is another confirmation that we will witness the move we want to see. Dear friend, that's it for this video. I hope this video provided value to you. If it did, please go ahead and smash the like button to show your support. And if you're new here, consider subscribing to our channel. If you want free signals from our trading team, comment below so that we share the link to you. See you in the next episode.